How to estimate commercial property value. Are you curious about how to determine the value of commercial properties? Understanding the methods used to estimate commercial property value is essential for anyone involved in real estate investing. Let's break down the key approaches that can help you accurately assess a property's worth. First, we have the income capitalization approach. This method is popular for income-producing properties. It calculates value based on the property's ability to generate net operating income. To use this method, you need to know the net operating income, which is the income left after subtracting operating expenses from gross rental income. Then, you divide that by the capitalization rate, which reflects the expected rate of return. For example, if a property generates $100,000 in net operating income annually, and the market capitalization rate is 5%, the estimated value would be $2 million. This approach is particularly useful for investors focused on cash flow. Next, let's discuss the sales comparison approach. This method estimates value by looking at recent sales of similar properties in the same area. You will need to make adjustments based on factors like location, size, age, and condition. By calculating the average price per square foot from comparable sales and multiplying it by the size of the property you are evaluating, you can get a good estimate. This approach works best in active markets with many comparable transactions. Another method is the cost approach. This calculates value by adding the market value of the land to the current cost of constructing the building. You then subtract any depreciation due to wear and tear. This method is particularly useful for new or unique properties with few comparable sales. It gives you a sense of what it would cost to replace the property today. The discounted cash flow analysis is another technique. This method projects all future cash flows from the property over a specific holding period and discounts them back to present value. It considers the time value of money and any potential changes in property value at sale. This approach is ideal for long-term investors managing complex properties. Lastly, we have the gross rent multiplier approach. This is a simplified method that uses gross rental income without deducting expenses. You calculate it by dividing the property price by gross annual rent. Then, to find the commercial property value, multiply the gross annual rent by the gross rent multiplier from comparable properties. While this method is easier to use, it is less precise since it does not account for operating costs or vacancies. For practical application, start with the income capitalization approach for income-generating properties to understand their cash flow value. Use the sales comparison method to validate market trends and ensure competitive pricing. The cost approach is useful for newer or unique properties. Consider the discounted cash flow analysis for complex investments with variable income streams. Lastly, use the gross rent multiplier cautiously as a quick screening tool. By combining these methods and adjusting for specific property characteristics, you can develop a well-rounded estimate of commercial property value. This knowledge supports informed investment decisions in the commercial real estate market.